Claim your free stock today with Robinhood.
Markets rebound. Not all stocks were winners today. Tesla finished in the red. The stock has fallen more than 10% in just the past 2 days. It's also now negative for 2021. Now,
Tesla Inc. is arguably one of the most contested stocks, with strong views among long and short camps. So far, investors who bought into Tesla hold the bragging rights, while avoiders and shorts have seen disappointing returns. In the 2020 calendar year alone, Tesla shorts suffered $38 billion losses. While trying to understand why so many investors got their Tesla call wrong, I keep coming across a refrain that the current valuation is too high or current valuation reflects several years of growth into the future. I've also repeatedly bumped into some lazy analysis that Tesla is expensive because its current PE is 1,270 times or forward PE is 204 times. However, I've hardly ever seen a Tesla bear put out a detailed valuation in support of their bearish thesis, which makes me wonder if a lot of people are simply dismissing Tesla in arrogance. So today, we're going to be analyzing Tesla from a value investor's lens by modeling its business over the next 15 years to a stage of maturity. But before we begin, remember this video is for entertainment purposes only. This is not financial advice. And if you like this type of content, make sure to smash the like button for the YouTube algorithm. It helps us a lot. And subscribe to our channel. Now, let's get right into this video. This is the first year when Tesla management has not provided its annual guidance on major business drivers like volume, profit margins, and capex. Management instead chose to paint a grandiose long-term vision with scant details on short-term milestones. Elon Musk's comments on 2021 outlook can be summed up in the following words. While 2020 was a turning point for Tesla and in terms of profitability, we believe this is just the beginning. We think 21 is going to be even more exciting. And you don't know what to expect in a given year. Obviously, last year we did not. Many things we do not expect. But assuming that 2021 is a relatively normal year from an external standpoint, I think it's going to be a great year for Tesla. A few moments before providing this cryptic near-term outlook, Elon Musk talked super excitedly about how the massive stock market capitalization of Tesla can be justified by the potential manifold increase in utility of Tesla cars, if used as fully self-driving or FSD robo-taxis, at some undefined time in the future. Even though this vague guidance is useless for prudent investors who need a clear line of sight on Tesla's strategic direction, it is more than sufficient to feed the endless fantasizing by Tesla bulls, who are already living in a Jetsons cartoon world where Tesla produces 20 million vehicles, enjoys worldwide FSD conversion, runs robo-taxis, and acts as a giant distributed energy utility. The only useful comments in the last conference call were from CFO Zachary Kirkhorn, who provided some more color by saying that we continue to expect a long-term volume compound annual growth rate of 50%, of which we may materially exceed this in 2021. As we increase production rates, volumes will skew towards the second half of the year, and ramp inefficiencies will be a part of this year's story, and are necessary to achieve our long-term goals. Specifically for Q1, our volumes will have the benefit of an early Model Y ramp in Shanghai. However, SNX production will be low due to the transition to the newly architected products. Additionally, we're working extremely hard to manage through the global semiconductor shortage, as well as port capacity, which may have a temporary impact. Lack of volume guidance in a year when Tesla has touched 1 million vehicles production capacity is extremely perplexing. Management has left it up to analysts and investors to forecast volumes depending upon their degree of optimism, ranging anywhere between 750,000 to 1 million vehicles. In a year when Elon Musk must be brimming with confidence after the unprecedented rally in Tesla stock price, leaving analysts out in the cold without any guidance, seems like Elon's revenge on Wall Street for years of asking boring, boneheaded questions. Most notably, the management didn't say anything about buying $1.5 billion worth of Bitcoin in fourth quarter 2020 during the January 27th conference call, and the news only broke when investors found this disclosure buried in the 10-K report filed on February 8th. In the days prior to this revelation, Elon Musk made a few tongue-in-cheek tweets about Dogecoin, another cryptocurrency, calling it the people's crypto. Although he didn't drop any hints whether at any point he considered cryptocurrencies as a good store of value for Tesla. The decision of the Bitcoin investment is pretty odd, as Tesla needs cash for funding its capex plans. The purchase is equivalent to 50% of the capital expenditure for a typical year. Investing such a significant amount in a volatile instrument is very strange and unprecedented among large corporates. It would be fun to see the management stripping out their gains and losses on their Bitcoin holdings in their non-GAAP earnings metrics and explaining the volatility to investors in upcoming conference calls. If anything at all, the move reinforces the perception among bears about the mercurial nature of Elon Musk as a person. Although lack of concrete volume guidance is a cause for complaint, let's make the best of what is available to see where Tesla could land in 2021. According to the fourth quarter 2020 investor deck, Tesla is entering 2021 with an installed capacity of around 1,050,000 vehicles, comprising 600,000 vehicles at Fremont and another 450,000 vehicles in Shanghai. It's likely that Giga Berlin will start up towards the end of 2021 and won't be making a significant contribution to this year's volumes. Given Tesla CFO's comments, it's quite obvious that first quarter 2021 looks to be a weak quarter volume-wise, due to Fremont S and X transition to new models, global semiconductor shortage, port capacity issues. My guess at deciphering the vague management outlook for 2021 volumes will be around 942,000 deliveries, assuming a slack in production during first quarter 2021 at Fremont, but a strong finish to the year when Giga Berlin comes online in fall of 2021. This translates into approximately 88% volume growth over 2020, which is materially higher than the long-term volume compound annual growth rate guidance of 50%. With an expected average selling price per vehicle of $51,000, Tesla is all set to generate revenues of approximately $51 billion in 2021. To err on the side of conservatism, I would pencil in zero sales of regulatory credits in 2021, as they are neither sustainable nor predictable and cause persistent whining among bears. In the absence of any profit margin guidance, I would conservatively extrapolate the fourth quarter 2020 automobile margins with some recovery in 2H 2021, resulting in EBITDA expectations of approximately $8.9 billion for 2021, growing to almost twice from 2020. It is not hard to see that Tesla has reached critical mass level in terms of its business model's ability to generate generous cash flows, as rising capacity utilization unleashes benefits of operating leverage. This also probably explains why management is giving a cold shoulder to Wall Street. Having established that Tesla has fine-tuned its business model in 2020, how you see its future growth trajectory is simply a function of how optimistic you are. In my view, it's neither fair to extrapolate a long-term volume compound annual growth rate of 50% into eternity, nor to think that a company with easy access to equity capital like Tesla will curl into a cocoon of inactivity after a hectic 2020. I would expect Tesla to keep tinkering with its gigafactories. To eke out a 50% long-volume CAGR over the next 5 years, I think Tesla will need to add about a total of 4 million vehicles production capacity by 2025. Given the cash flow generation from the business coupled with easy access to equity capital, ability to fund this level of volume growth is not a significant constraint. The real constraint is management bandwidth to execute capacity expansion at this breakneck pace. Having said this, I don't realistically see Tesla hitting the 20 million annual vehicle deliveries mark by 2030, even if we ask Elon Musk to camp out in gigafactories around the world in his sleeping bag 24/7 for the next 10 years. I think 20 million by 2030 is simply what Elon Musk called it in the third quarter 2020 conference call. It doesn't seem like a good goal to have. At best, one should expect Tesla to achieve only 50% of this ambitious long-term goal and still create an extraordinary amount of profits. The value in Tesla. Tesla might be a no-go for most armchair value investors after Warren Buffett said he would not invest in this company. However, a couple of notable value investors, Mario Gabelli and Joel Greenblatt, have been dabbling in Tesla shares with multiple ins and outs in the past few years. According to Guru Focus data, Mario Gabelli completely sold out his position in fourth quarter 2020, while Joel Greenblatt reduced substantially in third quarter 2020. I think Tesla has many characteristics which are sought by value investors. It has the ability to generate large amounts of cash flow as the utilization of its gigafactories rises. It also has an almost cultish brand loyalty, which can be gauged from its $0 spending on advertising. Tesla's competitive advantage lies in its early mover advantage in the electric vehicles industry. By capturing a larger share of the pie earlier on, it has the ability to enjoy learning curve effects resulting in cost reduction under Wright's Law, which has been made a cliché by ARK Invest. Buffett's associate Charlie Munger famously said that a great business at a fair price is superior to a fair business at a great price. Value investors who ascribe to this school are likely to warm towards Tesla if the price loses some of the froth. 2021 is turning out to be a year of confusion for Tesla. After finishing one of its best years ever, Tesla management is not providing any concrete guidance for the future, leading to investor apprehension. In my view, there is hardly a cause for concern, as Tesla's business model has reached critical mass level in terms of its ability to generate a huge amount of cash flows with rising capacity utilization, unleashing operating leverage. Ample internal cash generation and easy access to the equity market means that the only constraint to Tesla's growth is management bandwidth. Although not a screaming buy in any case, Tesla's great business at a fair price is superior to any fair business at a great price. Investors should take advantage of the dip to gain entry to this long-term growth play. Well, that's it for today's video. If you learned something today, make sure to smash the like button. It helps us a lot, and subscribe to our channel. Thank you.